But I just want to talk about the risks to multifamily. There's a lot of uncertainty right now. I think uncertainty is a good term to describe the environment we're in. And we saw uncertainty in 2020, back in the pandemic. But today it's even crazier. We have the war in Ukraine currently. We have, politics are always insane, but now they may be more uncertain than ever. Obviously, we've been dealing with the coronavirus pandemic. I mean, we have inflation, high gas prices. It's quite a timeline we all find ourselves in. Not to mention the stock market, the VIX, the volatility index is way up year over year. And the stock market is down, at least S&P 500 is down quite a bit, at least year to date, but quite a bit up over the last 2 years. Uncertainty creates opportunity. It creates inefficiencies. It makes people do things in a different way, and things aren't as balanced. And that is what is exciting to me, is to be able to take advantage of this uncertain environment. Because if we take, again, a long-term look, and now this is a chart, and this is looking at I believe the S&P 500 for the stock market, but this is a chart of all of major geopolitical events, really since World War II. And I don't have really geopolitics as a risk factor because it's so macro, but I did want to touch on it a little bit because obviously there's a war raging on right now. But even after the Pearl Harbor attack, there was some slight declines in the stock market, but over the long term, there was no major crash. And we can go back to any other of these major geopolitical events that took place over more than 50 years. And we see really, even the stock market, which can be very volatile, that can be very reactive to news in the short term. On the long term, if you focus on the fundamentals, we really keep moving forward. And I think that's important to keep in mind, is separating, the noise and the fundamentals of housing. Certainly macroeconomic events can affect renters and the economy, and a recession is certainly not good for any asset class. But we have to ask ourselves, how, will a war in Ukraine affect, housing demand in the Midwest? And actually, when we do an analysis, even though the war is absolutely, a horrible thing, some of the results end up actually driving multifamily through more inflation. So it's quite an interesting situation. But what can we do? Because if there's uncertainty, not taking action is not an option right now. Because not taking action is a choice in and of itself. Not taking action at times during 2020, there was serious opportunity cost and loss for not taking action and sitting on your hands during the pandemic. Now, that was an uncertain time, and everyone was waiting to see what would happen. But if you were paying attention during 2020 and you were tracking the data on a month-by-month basis or even a higher frequency, we were seeing, relatively early on that things were relatively stable and that the floor was not falling out. We proceeded to make acquisitions and made some of the best acquisitions we've ever made in the firm's history during 2020 because we were quantifying the risk. We took steps to mitigate it, and we adapted to the current environment. So that's what I want to talk about. Some of these risk factors, how to mitigate it, how to mitigate, quantify, mitigate, and adapt. So the first risk facing the market that is top of mind for everyone in any asset class is Fed tightening and potential interest rate shock. The Federal Reserve has ended their quantitative easing buying of mortgage-backed securities, and they're expected to raise interest rates next week, at least on the Fed funds rate, by most likely 25 basis points. Some Fed fund futures markets are anticipating up to 7 interest rate hikes this year, but I don't know how much weight I would put on some of those futures markets at this point. But regardless, it's important to take a look because obviously the cost of borrowing capital is significantly important. And to be able to really quantify this risk factor, we're looking to a research report that Berkadia put out a little over a month and a half ago, I believe, and it titles Interest Rate, Stagflation, Inflation, and Monetary Policy, all related to multifamily. I thought I think it's a very kind of apt piece for the times. Some of the key takeaways is it changed the monetary policy appear to take 5 to 6 quarters to affect leveraged apartment returns. But surprisingly, real apartment returns outperform equities during times of quasi-stagflation, and we haven't really had real stagflation in a while, but real apartment returns still outperform the stock market. They're telling us to keep a close eye on the 10-year Treasury break-even inflation rates. And then average leverage apartment returns tend to remain stable even during high times of inflation, which makes a lot of sense because you're re-signing one lease on a yearly basis. But if you have a large portfolio, and think about the Gray Fund, 7 to 10 assets, we're talking, easily, over 1,000 apartment units, you're re-signing new leases on a daily basis. And so we have the ability over the entire portfolio to track inflation on a daily basis. So higher inflation is actually very beneficial to a multifamily investment. And the multifamily has just historically proven time and time again to track inflation. Then the taper tantrum, because not only is the Fed raising interest rates, they're going to be unwinding their balance sheet. Looking back to 2013 at the last taper tantrum, multifamily was essentially unfazed. Let's actually look at some numbers. Average leverage apartment returns in an inflationary environment. You can see that really in the 1% to 4% inflation range, multifamily apartments perform very well. And they really start performing well, getting up to 7%. But the takeaway here is, inflation can cause a lot of uncertainty, but inflation means higher rents and continuing to drive returns. So while inflation can be scary from a macroeconomic standpoint, if you're allocated to apartments, you should really be able to sleep well at night. And if you're concerned about inflation, rising gas prices, multifamily is where you want to be. Now, this next graph looks at the relation to apartment yields and the 10-year Treasury. So that we're looking at, let's look at rising interest rates. There's really not a great correlation. Berkadia's conclusion is the relationship is not straightforward. You can see that returns go up kind of in this kind of between 0 and 2%, and they seem to decline over a period, and they go up when the rates are even higher. So it's less certain there's less of a correlation, or a direct correlation at least, between leveraged apartment returns and just the 10-year Treasury or just interest rates in general. And a lot of that is because, as interest rates rise, assuming that inflation is high and rents are also rising. So it's not just that interest rates go up and returns go down. That's obviously just not the case. This is again looking at the 10-year yield as well as, again, private apartment returns related to the 2013 taper tantrum. That's been a major concern. But if you really can see in this, I believe it's a blue line, there was really no effect from the taper tantrum. In fact, returns went up slightly. But there's no real correlation between taper tantrum or tightening of the balance sheet and apartment returns. Are really somewhat isolated. Now let's look at stagflation. Stagflation has been talked about more recently. Now, stagflation is essentially high inflation and low GDP growth, or high unemployment. And so they took a couple examples of environments since 1987 that were quasi stagflationary. Stagflation was coined in the 1970s. And what they found is that, while the Wilshire 5000, so, broad index of the stock market, had about a 3.8%, private apartment returns significantly outperformed, especially compared to higher growth asset classes such as technology companies that might be comprised in the NASDAQ benefit.